Good afternoon, everybody. Thank you for joining us today at our very interesting topic name for a presentation. So today's topic, as part of our regular monthly webinar series, is ESG and Asia, Oxymoron. And it's drawn quite a lot of attention in the last couple of months and more so in the last couple of weeks, as more and more investors are very much focused on this topic of ESG and how important it is as part of an investment process. So what I have brought in today, or who I've brought in today, is Frank Tsui. So many of you over the last couple of years who may have attended our roadshows may have seen Frank present in the capital cities across Australia. Frank is also now the Managing Director and Head of ESG Investment. So who else and who better to get in front of you this afternoon to talk on this topic. Before we jump straight in, so just a couple of housekeeping issues today. This presentation, as usual, is being recorded. So after today's presentation, over the next few days, you will receive the follow-up email with a copy of the deck that you see, as well as a copy of the recording. So please feel free to pass that on to any of your colleagues that may be interested in watching this presentation as well. The other small housekeeping thing is that our TMDs are obviously live up on our website. We've also placed it within this PDF presentation on the final page, and so that will take you to direct link to those TMDs. We're pleased to announce that there are no distribution conditions on any of our funds, and all are placed in that satellite portion of a portfolio, which is not exceeding more than 25% of a client's overall portfolio or wealth, depending on how you set the benchmark or measure that within your own practice. Please feel free to reach out to us if you have any questions around the TMDs, but for us it was quite straightforward, which we're quite thankful for. So standard disclaimer, today's presentation obviously is general in nature only, and please seek professional financial advice, as we know we have some direct investors on today's call as well. So giving everyone a quick update about Value Partners and where they stand today. So VP now manages just under $11 billion of assets split across fixed income and equities. And so one of the things that we're also going to highlight today, and I guess what's transpired over the last couple of months, especially with Chinese equity volatility, is our sort of position on Alibaba, something that we've held very strong views on for a while, and it's a topic that I'm going to sort of unpack a little bit with Frank when we talk about the current positionings of the portfolio, because arguably, as the name suggests, Alibaba, after its very graceful fall from prevalence late last year after the fail of the Ant Financial listing, technically should be a value investment now. But is that a value trap or something else? We'll dig a little bit deeper into that shortly. The team remains very stable with 70 investment professionals right across Asia, from Kuala Lumpur, Singapore, London, Shanghai, Shenzhen, and our headquarters in Hong Kong. And we're very well resourced, which we'll also dig into a bit later on. So our investment team, we've got 37 of the 70 team members within equities, very well resourced, as well as our fixed income team of 11 members headed by Gordon Ip, who we will talk about tomorrow at our fixed income monthly update. So a lot to cover there as well, especially around the property sector. So if you haven't registered for that, please feel free to register for tomorrow's presentation as well. So one of the key, I guess, attributes of Value Partners investment thesis and philosophy is that on-the-ground research cannot be beaten by report writing or report reading. So the ability for the team last year to complete 8,500 company visits, and on average at least doing 6,500, truly brings out the best of breed ideas, which are now fed through the high conviction pool in stage 3 of our investment process, which allows a consistent application of the best ideas into each portfolio. And so the culmination of those ideas, as you can see, have come put on the screen there in terms of our performance since inception, obviously now we've drawn a lot more interest given our fee cut, which is now at a very competitive flat fee basis of 133 basis points without a performance fee. So we removed the performance fee and dropped the management fee by 0.5%. Since the 1st of July of 2019. So that's why it's come on the traction level that it has amongst advisors, especially given how strong our track record has been net of fees. Our Sharpe ratios and information ratios maintain best of breed as well. So we're very, very proud of this track record. And the one thing that really highlights the value of what we've provided to the market in Asian equities over the last 10 years is the information ratio. As what you can see there is very difficult in actual fact for active managers to outperform the bench without taking on excess levels of risk. So something that we've done very, very well over an extended period of time. So with that, Frank, I just wanted to move on today's topic around ESG. So, I mean, ESG and Asia, we set the topic as it's an oxymoron, question mark. And I guess the first question to you is ESG not typically associated with developing countries? And if so, why is that?
Yeah, sure. Hello, everyone. First of all, I mean, it has been, I think the last time I had roadshow with Jonathan, it was back in 2019.
Yeah.
So, I very much wish that I could, see the familiar faces when I'm talking, but just unfortunately we're, in a virtual platform today. But still, my pleasure, and thank you for your time just to, dialing in on this platform. And this topic, ESG, is definitely a very interesting topic to share about. I think going back to, just the questions about ESG developing countries, I think 2 years ago, it was a complete different landscape here in Asia. I think what we're dealing with here in Asia as the developing country region, first of all, you're dealing with a huge divergence among different countries. So I think Jonathan listed out, the slide here, the size of the economy, population, as well as the, the breakdown on GDP contribution. This is the only, kind of like a small part of the divergence that I'm talking about here. But when we're just looking at the diversity, here in Asia, I think first of all, we will be looking at, the perception. When you're looking Asia as a developing country region, from a developed market point of view, I think the perception has to be adjusted. Because simply put, you're looking at, the kind of, you're asking like a toddler to run, instead they're just, learning how to crawl. So Asia is still far behind the curve, if I were just to say how ESG is developing here in Asia, but they are growing at a very, very swift pace in the last 2 years' time. I think before I go into, the latest development, I think there are a couple of things that we have been really considering from an asset manager point of view. And that has actually been presenting a lot of challenges here in Asia, despite the swift and fast developments. First is when we're looking at the divergence, first we're looking at the culture divergence. Here in Asia, in different countries, we have like 13 listed market, big markets we're looking at. They speak, 13 different languages. This is something just to begin with. Culture perspective, a lot of the countries, some of them are, majority of the companies are SOE are owned by the government. Are they willing to disclose more, or do they have the incentive to disclose more? This is the second thing. Third thing is the regulation. Among 13 different markets or countries, the code of conduct, the code of governance, the stewardship code, the level of disclosure are also very different. Let's say in Korea, they are required to disclose information in Korean language English is not something that is compulsory. Of course, for large cap company or the big cap companies, you will see the English annual report. But for mid to smaller size, they can just provide the local Korean language annual report, and not to mention about ESG disclosure. In Japan, they're very disciplined, but they don't make the ESG disclosure or this code of stewardship disclosure compulsory. So they still rely very much on the companies to disclose on their own in a voluntary basis. And in South Asia, the culture is also very different in a sense that the regulations, there's like some of them, they don't even have ESG or climate stewardship code of conduct disclosure requirement. And I think lastly is about the level of disclosure. The level of disclosure also varies among all these countries. So let's say some of the companies are required to disclose on an annual basis, and some they don't. And we're talking about a huge divergence in terms of the data compatibility, relevance, and the timeliness of all this data disclosure. So going back to your questions about Asia, developing countries, yes, we have been seeing tremendous picked up in terms of awareness, in terms of regulator really stepping up just to require listed companies to disclose more, but it's coming from a very low base. That means you'll be seeing continuous, very high momentum of developments, which is a positive thing. But looking at here at Asia, so if you're putting the developed market standard in Asia, I think unfortunately that will be, there's still a lot of things to catch up. Just yes, as I said, you can't ask a toddler to run when they're just starting to crawl. So that's where we're at right now. Yeah.
Yeah, I mean, if we talking about that difference, I mean, I guess one of the stark differences around the different standards in ESG that we see at the moment between Asia and I guess developed markets, if we can call it that, is that the underlying ownership structure of listed companies is very different to developed markets. So is that in of itself, I guess, an ESG barrier, a barrier to ESG investment?
Yeah, so as an asset manager, I think sustainability or responsible investing actually has a big role to play when it comes to the engagement with company. So the structure of the market in terms of who owns these shares here in Asia does present a challenging environment. So when we look at this slide here, the percentage of shareholding held by institutional investor versus retail. Asia, we're just talking about around 42% versus the developed market 61, in the UK, and 84%. Different mass amount of shareholders to agree on some of the agenda that we are trying to push forward. And of course, I mean that this is also the reason why we're seeing increasing amount of collaborative engagement with different institutional shareholders, such as asset managers. They're getting the ideas about getting together and try to bring a more significant impact on the company level. But the engagement, if we look at the investor structure, I think it's also pretty diverging as well. If you look at say Hong Kong, definitely is much better because it has been really much about considered as a developed market. I think Korea is improving. While in South Asia, if you look at Philippines, if you look at Malaysia, I think this shareholder structure among different diverging factors, I think the shareholder structure is something that will take longer time to evolve. I think China is actually looking good in the sense that they're opening up MSCI Asia inclusion, indices inclusion will drive more institutional investor in China market. And obviously we have been seeing a lot of developments in China from a regulator perspective. So I think out of these the list here, I think the shareholder structure in South Korea, in China, and also in India, I think they are looking fine, and I think the institutional level will continue to drive a lot of changes. But for Southeast Asia, I would expect a little bit more time because the culture, because of the and not only it's not owned by retail investor, but also about the government owned, and also the big family shareholder structure will also drive a lot of challenges to make change on from an ESG perspective.
I mean, Frank, do you think that journey is like, a 10-year journey, a 5-year journey? Is there sort of a very concerted effort in the region to improve it, or do you think it's a very slow-moving beast because there's other priorities, as we've discussed?
Okay. So how we are looking at the timeline, how we quantify the number of years, we'll be actually looking at 4 ingredients. So I think the whole ESG ecosystem involves the regulator, asset owner, asset managers, and listed companies. So these 4 factors will be driving the whole developments. I think in Hong Kong, or maybe in China, or in South Korea, we're seeing these 4 ingredients have been seeing a lot of synchronization, a lot of collaborations. So they actually affect each other, and I think this take all these hands to clap in order to make it work. So I think in China, or in Korea, or in Hong Kong, we're seeing a lot of pipelines, and that's why we could tell maybe let's say 5 years down the road, 6 years down the road, such as in Hong Kong, we will be adopting the TCFD, so which is the European standard next year, which will be effective next year, and that will be driving a lot of fast developments because regulator is coming in, and you're required to do it. So all other the whole ecosystem will actually start to work. So maybe say Hong Kong, China, we'll be looking at about 6 years, 7 years that we will be catching up with the more developed countries. But whereas in South Asia, I think they do have the slogan, they do talk about ESG, but when you're really kind of like reaching out to the corporates in South Asia, you could see and you could feel the intensity there is much lower than markets like Hong Kong and China. So I think for those like countries, it may take more than a decade, but that depends on the developments of these 4 ingredients within the ecosystem. So yeah, it will take quite a bit of time to catch up, and to be on par with the curve and with the developed countries. But looking at where we're at right now, I think Hong Kong, China, I think South Korea and India. I don't say Japan because usually we talk Asia ex Japan, but Japan is definitely. I think it's if you consider Japan as the Asia Pacific region, then I think Japan is definitely leading. But yeah, coming after Japan will be I think Hong Kong, China, and South Korea.
Sure. I mean, if we then now break down the individual elements of ES and G, I'll just put up this slide here. I mean, what are we looking at here in terms of that divergence in disclosures?
Yeah, I think this chart actually shows to help everyone to visualize the challenges and the divergence on from an asset manager perspective, because governance is something that I'm not worried about when we're assessing company, because obviously when throughout our journey since 1993, governance, the G, is something that we have always emphasized, because the management quality does give a re-rating or de-rating. It is a factor to drive de-rating and re-rating. ESG, E and S, however, are something that is still far lagging behind. So you can see the chart here. I'm not going through every single individual country, and this also tells you why I think some of the Southeast Asia countries such as Indonesia, you'll be seeing a longer time to catch up, because looking at environmental, social, there's kind of like really lagging behind other countries. But I think the level of disclosure, E and S, is something new to Asia region. When we're looking at the company disclosure level here in Asia until maybe say last 1 year time. So E and S is actually giving a little bit more structured way for companies to disclose some of the data that they did not have or they did not disclose before. So I think this is the catch-up that I was referring, that they're still at early stage and they'll pick up. And this chart actually shows another very good example about environmental related matters such as climate impact in Asia. Europe basically is, I'll probably say, is the most advanced ESG or sustainability investment region on this planet. So basically, over 95% of the asset managers will consider will conduct climate scenario analysis, but where in China is zero. So this is the kind of the divergence that we're looking at. But if we're looking at the next slide is actually even more interesting. When we're looking at climate related analysis, this is Jonathan, if you could go to the next slide. Yeah, this is one of the upstream companies that we like. It's a material kind of like a supplier to some of the green energy related companies. So obviously it checks the box as considered as a good environmental and climate impact company, because they supply good material to some of the new energy manufacturer. But when this company is listed in Asia, China Asia market. So I think this Yi as this year, let's talk about Yi first. When we try to look up what data can be assessed, what data can be quantified, unfortunately no data is available. So I think this is what we're dealing with here in Asia, that it will take a much more efforts to discover a company ESG developments than the developed countries such as in US and Europe, because there's no data available. And that's why you will be actually have to really digging deep to talk to company if they're willing to talk to you about ESG contents. And I think for us, let's put it this way. I think in Asia, we'll be viewing the transitional process is more crucial than just simply identifying which company is a good or bad ESG company, because they're just starting to ramp up. They're just starting to develop their ESG efforts. So and this transitional process has to be monitored to identify what are the corresponding risks and corresponding opportunities. Companies that will be stepping up to put in a lot more efforts to disclose more, I think they deserve a re-rating opportunity from the ESG angle. But those companies that are kind of like falling behind the curve, that they're lagging, I think they will be derated just simply because they are not catching up with their peers. So in Asia, the approach is very different. That I will have to say that when it's just like looking at companies when we're looking at companies, whether their share price is cheap and whether there's like a re-rating opportunities. The re-rating part, how we're assessing it in ESG level is to monitor the efforts, the developments that a lot of the companies are doing, and whether they will be deserving a re-rating opportunities. And this requires quite a bit of deep dive and close dialogue with the management, because here in Asia, a lot of the companies are starting to make up a lot of like ESG reports, ESG disclosure. Management are saying, oh, they're very committed to ESG,
Yes.
related agenda. But you could find a lot of them, they don't have a pipeline. When you ask, the management about, what's their KPI, I think some of them are still, very lacking. And and I think it's just like a very typical way to invest, to analyze a developing country company level. It requires a lot of cross-checking. It requires a lot of understanding about the management quality, and also about the execution capability. So I would say it applies pretty much the same as what we've been doing on analyzing an equity here in Asia. But ESG is more of another framework to assess a company on ESG levels. So yeah, this is, I think, that the divergence that we're dealing with, the developments, how we are looking at the ESG opportunity and risk in Asia. I think it's a very different measurements compared to developed countries, such as in Australia as well.
I mean, if we if we then look at that comment that you said, the companies say all the right things, right? They're effectively doing lip service and saying, yes, we care about ESG, and this is, but it's all very broad brush. Maybe they're motherhood statements. And then the follow-up, as you said, is that there's no disclosures at all, right? So that's the fundamental challenge of how do you match what they say against what they do. I guess then if we move on to sort of from the asset management side and looking at the value partners approach, because as we discussed, what I want to bring out for the audience today is actually the journey, because ESG is not a linear journey for a company. It's also not a linear journey for an investment manager.
Yeah.
One of the biggest risks that we sort of see on the investment management side, even with the managers that we evaluate and research, is that there's this risk of greenwashing. Okay, so managers can also come out and talk about how important ESG is, and they can maybe take an off-the-shelf type solution. I mean, do you see greenwashing as an issue for Asian investors?
Yeah, I think obviously yes, because greenwashing basically I think it could be quite common here in Asia. When a company or when an asset manager kind of like step up and say, okay, we're doing ESG, we're doing sustainability investment, and looking at what we had just gone through, the divergence, lack of data disclosure, the extra amount of efforts to discover a company ESG developments. I think one asset manager has to have a very dedicated resources and team to dig out all these facts on ESG level. So I think greenwashing could be easily applied here in Asia, because when we say something, we want to mean that we are really doing it. But some of the policy that you could see in the market, they're trying to do this and that, and I think some of them even apply the European standard, because some of the names they will be using what they have engineered in Europe or in the US to apply here in Asia. And a lot of things won't work because the data is not available. So from my point of view, I mean, they're not intentionally doing something that that they cannot do. But the fact is that look at the market. I mean, the data availability, compatibility, all these things, will be making a lot of the asset managers to fall into this, kind of like greenwashing thing. So it's actually, it's a chicken and egg kind of like a situation. So how we are just doing or viewing the ESG process here in Asia is that we started thinking about the ESG policy or sustainability policy back in 2017 when there are more awareness here in Asia, and not until 2 years later in 2019 that we kind of like stepped up and became the UNPRI signatories. At the very beginning, we're starting everything from scratch. So I would still consider ourselves as a toddler, in 2019. But let's say we were doing, say, 30 miles per hour back in 2019, and throughout 2021, we have really accelerated and stepped up a lot in terms of how we're looking into the ESG developments. At the very beginning in 2019, when we first started, it was just a very basic kind of approach that we just used negative screening, which a lot of people would do because that's the easy way out. That we are doing some ESG considerations, but also without really, deploying huge resources and efforts. The negative screen is just, kind of to screen out those ESG violators. So that will be really much be based on the third-party rating agency to give us who are the significant ESG violators, and we maintain the exclusion list. So at least I think this is the minimal kind of like the minimum standard that we could apply at the very beginning.
Yes.
So in 2020 and 2021, so we have been assessing what's our stance, what's our proposition, and what's the most effective way to assess ESG. Some people would just look at using external rating agency, which I think is also a good thing. But sorry, Jonathan, maybe next slide. Yes, the next slide. So this is the level of ESG complexity kind of chart that you could look at on how an asset manager can do their things. So negative screening is the most basic thing, and the most sophisticated is proprietary ESG assessment. So in between, we could apply positive screening. We could apply a norm-based screening based on another higher level of ESG rating subscription package. But the problem is, I think when we look at different ESG rating agency, what we found was that the different rating agencies, they have like different methodology and different matrix to assess a company. A good company, a good rating ESG company in a rating agency A could be a very bad ESG company in rating agency B. So so we started to study what's the rationale behind, what's the methodology, and I think one pushback for us to to further kind of subscribe to the rating agencies that the timingness of those data, because a lot of the rating agency here in Asia, the coverage, they have just started to ramp up. So obviously, majority of the companies will be assessed, let's say semi-annually or on an annual basis. I do have a very close engagement with one of the rating agencies because Value Partners is a listed company, and literally we got a very bad rating on ESG level by that rating agency. So I reached out to them, and I'm trying to understand why we got the lowest ESG score, because I realized some of the data was available, but in their report they said we did not disclose it. So it was quite a
or wait.
long, yeah, it was quite a long process to discuss with them, because they don't allow me to speak with their analysts covering our company. So I have to go through different ways to talk to them and say, hey, this is something that we had already done, but it's not reflected in your report, and literally causing a very low ESG score. So what I realized is they only do it on an annual basis in November. So I still remember it vividly. and they would allow company like us to supply data or information, and they will receive it and consider whether they should make a change in the rating. But usually when you supply those data, it takes them normally about say 2 months time to respond. And usually they will let you know they would generally consider to change the rating during the annual exercise. So that gives me a feedback about they're not really reaching out to companies. They don't have that touch with the management directly. So they're just really based on what are publicly available, what are on the website.
Accounts, things.
And a lot of them, they're just looking on a. I mean, this is the most crucial part. They're really backward looking.
Yes.
Where we stand today is it's not really reflected in the scorecard. And when we were talking about this swift development, the fast developments in ESG efforts for Asian listed companies, 1 month, 2 months, or even like 3 months could make a huge difference, because we come from a very low base. So that's why I think a lot of the rating, ESG rating, could be overly punish or over reward a company on ESG level. So you really have to have a live chat, or maybe a routine chat with this company when we're transitioning from lack of ESG disclosure to having ESG disclosure. So I think what we had decided at the end was to create our own proprietary coverage. I think this is the most kind of efficient way, despite we're starting from scratch. Despite it will take a lot more efforts and resources to build something, but I think this is a better way for us going forward, because once we got the proprietary data, it's just like the concept of big data analysis. Having a small amount of data wouldn't make any meaningful signals or indicators. But once you get that data accumulated in-house, and we could do a lot more to monitor the transitioning opportunity and risk, and also about which companies are giving us a signal that they're really improving, and who are really deteriorating, or who are really not catching up. And I think lastly is also about we're implying more forward-looking kind of factors by having conversation with the management, because we could leverage on our existing equity analysis, because we do have a company meeting, one-on-one meeting, at least on a quarterly basis, because of earnings announcement. We could actually, our analysts are able to talk about different things, including ESG, with the company. And I think the proprietary would work better for us to understand the company more. So proprietary ESG scorecard, we have been applying different considerations, and this is not something that we will stop here. because this depends on the availability of the data. We're not trying to say, we're pioneer, we're, doing, we're applying the same standard as the European asset manager, simply because a lot of data are not available if you apply that, standard. So these, let's say 1 year from now, if we could have another, ESG presentation. I'm pretty sure the ESG scorecard, will be, will have a more full kind of like content.
Yep.
Yeah, so I think this is, the kind of the developments that we're taking, that we think proprietary coverage, having our own data, having our own assessment is the most efficient and effective way to look at ESG opportunities and risks. Relying too much on ESG rating agency, I think it's not bad, but that might actually give you extra level of complexity, because what you think may not sync with what they say in the report. So you may end up putting a lot more, time and resources to understand what's the difference between your findings and the ratings given from the rating agency. So I think this is what you had mentioned at the very beginning, Jonathan, that we have 70-ish investment professional. We have a huge team here in Asia, and I think that gives us a little bit edge, just to that allow us to get more understanding on ESG level here in Asia.
Fantastic. So with the last sort of 15 minutes or so, and for anyone that has any questions, as usual, please put your questions into the question box on the panel on the right. Is obviously we've seen a lot of volatility in markets, Frank, especially in the last, I guess since the beginning of our financial year in Australia, which has been July. After a complete, a very, very stellar 12 months to the end of 30 June this year.
Yeah.
I mean, how are you guys seeing the market? Like, we've talked with a lot of our clients, especially, I guess, around, we've been out of Alibaba since, October, November last year after the Ant Financial listing failed. A lot of global fund managers stayed in. And a lot of people have, accused us over the years of being, deep value. So why are you investing in growth stocks? So I guess in the roundabout way, I mean, we're still out of Alibaba, and Alibaba is still a very, considerable part of the benchmark. But now it could be argued as a deep value stock. I mean, how do you see that? And are we looking to buy in?
Sure. Okay. So just before I go into Alibaba, I think maybe I could just kind of have a quick, sharing on what we think about the market at the moment. I think this year we haven't had a very good year on equity level. First of all, because during February there was a lot of inflation expectation, the steepening yield curve, that's causing the growth to value rotation. So that's one thing. Particularly in China, starting from third quarter, so that was starting from July. So it was a very eventful quarter in terms of policy clampdowns, policy announcement, and to a certain extent, I think it was unprecedented because usually when a policy reform rolled out, it will apply to one or two sectors, but this time it's rolled out in a much broader level. Including education. That's something that that was started, and then followed by e-commerce. I think e-commerce was from last year, but the data security thing will follow. The education, and then the Macau gaming, and then healthcare, and then property sector lately. And in September there was a power shortage. So it was a very eventful quarter that's driving a lot of volatilities, and to a certain extent, people did not expect it to happen because of the scale, and also because of the intensity. Everything was announced in 1 quarter of time. So I think this year, if we kind of like take a step back and view the overall policy direction, you could argue that this is not, to a certain extent, totally unexpected. This is not totally unexpected, because since last year, or since even President Xi Jinping, when he came into office in 2013, uh, he has been a style that is driving quality. That he's there to fix a lot of issues. So when he first came in to the office in 2014, if you have like the tracking of the anti-corruption campaign, a lot of the government officials, that's what we call, catching the tigers. The number of government officials that get caught was over like tens of thousands, back in 2014. So I think that has been a huge, clear objective from President Xi in the last few years' time, that he is trying to take a very preemptive measures to ensure the growth of China will actually have sustainability and equality. So taking education, e-commerce as an example, uh, what had happened in the last decade was it has empowered a lot of monopoly, the big leaders. So a small group amount of people and corporates had benefited a lot, while making a lot of like entry barriers for smaller players in the market. And this is not something that is aligned with the policy direction. So education is the same in a sense that common prosperity, they actually want social harmony, social prosperity, and also China needs the soft power to drive the growth. And the aging population has been one of the issues. So they want to make everything easy for parents to give birth. So that's a lot of like, it's, the common prosperity thing is actually, we could have another 1 hour sections to discuss that. But
Of
simply
course.
put, President Xi, he's trying to fix a lot of problems created from the previous decades. Because the previous decades, China's agenda is to uh, ensure growth uh, without thinking, or by sacrificing a lot of different uh, uh, issues. So there's a lot of problem literally created from the previous agenda. So he's trying to fix it. So I think to us that the policy would be negative to a certain extent in the near term, but I think it's better to have some preemptive measures before there's like a bubble forming or the huge bubble burst and creating a systematic risk. So this is first thing. So what I think about the volatility in the market is it could persist for a little longer, but we could also see how China is standing from a valuation point of view. Now MSCI China excluding Asia, so that's more of a relevant comparison, because Asia has been included in the index since 2000. I think that was 2016. So when we take it out, so we have longer track record to track the valuation. Now it's about 0.6 standard deviations below 20 years average. Now it's talking about 9.9 times for PE in China, which I think is quite reasonably valued. So I think some of the sectors, however, will have a very diverging kind of approach, because Alibaba e-commerce is still a sector that we underweight. Alibaba now, I would consider it as a very good value play because uh, obviously in 2022 they're trading around like 14, 15 times PE. Um, Unfortunately, that's not looking too attractive to us, because when you're looking at valuation in an absolute term, it looks attractive, but we need more catalysts. We need to identify the catalyst to drive that mean reversal. So that means uh, we try to avoid the value trap. I'm not saying Alibaba it's a value trap, but why it's actually pricing at lower level or much more attractive level than before was because Alibaba's a lot of the business units are facing policy overhang, and in which there's a little visibility for analysts to price that part of the growth. So a company, when the visibility has gone down, people tend to have like more conservative estimates on the company, and uh, the company obviously people think they don't deserve as much as premium as before, and there has been a lot of re-rating. um, I think for now, we like Alibaba e-commerce platform, which is still their core business, but the data, the fintech, a lot of the other business units, which used to have a much higher or brighter earnings outlook, it becomes a bit less, a bit more uncertain right now. So I think this is why the key reason why we think the market shares will have pressures to grow, and literally causing the reduction in our portfolio since late last year. And I think in this market, one good thing about an active management approach is that we could avoid an index heavyweight member such as Alibaba in our portfolio, and create more excess return from some non-benchmark, or by having a higher active shares in our portfolio. So this is where we're at right now. We're actually more positive on some of the technology hardware. What we try to do is we are doing two things. We try to avoid sectors that have heavy policy headwinds, and we try to go for the sectors instead with policy tailwinds. So I think technology hardware. This is the Premium Asia fund. We try to buy, get more technology hardware, simply because the supply demand imbalance continue, and we are seeing margin will continue to have momentum to expand more, and we are also very positive about consumption related sector, as always, because the consumption power is increasing, and there has been a lot of like consumption upgrade that people are spending more, and this story still remain very intact, and nevertheless is more immune from the policy implementations that the policy measures or clamp down is very targeted to specific sectors, and I think there are little kind of like policy headwinds within the consumption space, and financials is another thing that we're more positive now, but we're only limited to the wealth management related financial platforms, because that will benefit from it's you could argue that's like part of the consumption upgrade themes, because the affluent class, the middle class, the rising middle class, there are more wealth to spend, and particularly in China, the the asset allocations from a household wealth perspective is very imbalanced. That 60% of their assets is in property, and only 6% is in equity, and 6% is in wealth management products. So it's actually quite distorted if you're comparing with other other regions or other developed countries. So consumption financials, technology hardware is something that we're looking at. We did have a bit of some COVID recovery play. So we used to have some shipping container companies, but we had been taking profit from that, because the shipping container company has gone up more than about 80% year to date, and we started to accumulate those shares in late last year, because we're seeing other parts of the world that shipping. I think you guys would also read the news. The ports, the shippings, because of COVID, there has been a huge disruption.
Taking longer.
Yeah,
Everything's taking longer.
Yeah, so China, because it's the first in first out country, the shipping, container, logistics, everything was kind of like resumed to normal since the second half of last year, and that's why Chinese shipping container company has been taking up a lot of market shares out from other regions which are still suffering from the COVID thing. So, but that's something that we have been doing. I think under this kind of like environment, the active management approach, I think, will be more rewarding, in this kind of environment, because there's a lot of like diverging kind of targeted policy in specific sectors, and monopoly, anti-monopoly, antitrust will actually target to big players, and being passive in the buying the ETFs, it could be quite punishing, because a lot of the big names, big guys, they are being targeted because of the anti-monopoly thing. So this is what we think right now. But I think from a valuation perspective, it's looking very attractive. 0.6 standard deviations below the long-term average is always something good to look at. But buying or bottom fishing, target timing the market is always challenging. Usually, the bottom will actually happen well before the market start to pick up. So
yeah,
I
mean,
cannot,
we
yeah.
Yeah, I mean, we've been reminding our advisors that every 4 to 5 years there's this sort of quite volatile period that hits Chinese equities, whatever it may be. Kids committing suicide because they're playing too many games, governments attacking monopolistic behavior, and fundamentally, even with all this latest round of policy shifting or announcements, you could call. No one fundamentally disagrees with it. Even in Western democracies, people that we speak to in Australia, New Zealand, no one disagrees with it. Things like kids shouldn't play so much computer games. Kids shouldn't be subjected to ridiculous levels of after-school tutoring. Property houses shouldn't be so high. No one actually disagrees with any of this. It's just, people are uncomfortable, I guess, with the approach of the Chinese central government, but it is for societal good. So the government's not there to just attack every sector. It's not in their interest, in the same way that they're not trying to destroy the property sector, which we're going to talk about tomorrow during the fixed income webinar. Frank, we've got one question, and we'll finish up on this question because I think it's a good one. I mean, we've held TSMC in the portfolio for a while. And as we've been observing, we've reduced actually our allocations to TSMC, Samsung Electronics, in I guess the last couple of quarters, and we've started to see other companies sort of creep into the top 10 that also seem to be manufacturing semiconductors, like ASC Technology or United Microelectronics Corporation. So the question from one of the audience is, I mean, what sort of risk do you associate with TSMC given the aggression of China towards Taiwan and our holding of that position?
Sure. Okay. I think obviously the reductions of our TSMC holdings is not because of any deteriorating factors, but the share price has just been doing quite well and is approaching closer to our target price. So this is our self-discipline that we start to kind of trim the position and redeploy the process to other names that we think are still trading at compelling valuation level. But addressing the geopolitical concerns about TSMC's exposures in China, I think I'm not too worried about the TSMC position. Reasons being is TSMC, one thing that makes them so strong, so unique, is the technology advancement. Among the overall semiconductor foundry relative to South Korea, TSMC is getting to 3 nanometers going into 2022, and obviously others are still catching up. There's still a gap to catch up. So for TSMC, it's good in a sense that in Taiwan there's no anti-monopoly or antitrust kind of like thing that they won't have that potential policy clamp down, but I think they're really good in a very high quality company to also not only get exposures in China, but also get and secure the big names such as Apple, the global names in the US and Europe. those are very secure client, from the TSMC list. So, and even like, let's say in China, I think that was back in 2018 when Huawei got banned, and Huawei cannot get respective technology components from different parts of the world. That's the natural shift to other players who will actually gain the market shares. I think TSMC is not particularly dealing with China, as a country, but it's more dealing with the global, demand on, IoT devices demand. I think recently we've just been seeing some weaker than expected data on, smartphone demand and also tablets demand, and I think the TSMC is just having a very strong pricing power because of its technology advancement. So we're not, trimming the position because of the deteriorating factor or the weak macro data, and also we're not too much of a concern about the China issues, because other semiconductor or technology component chip maker, they will take up the market shares from that. So eventually it will still be going to TSMC on the higher end part of the IoT devices level. So that's my view.
Okay, excellent. We'll leave it at there. We've gone over a bit over 1 o'clock here in Sydney time. Thank you everyone for attending. As mentioned, you'll get a follow-up email in the next couple of days. Any other questions, please feel free to reach out to us on the details on screen. And remember, if you want to hear more about the property sector and our views for that, please tune in tomorrow for our fixed income webinar. So Frank, thank you very much for your time, and I wish everyone a rest of a good afternoon. Thank you.
Thank you. Yes.